Imagine you inherit your grandmother's property and manage to sell it for $300,000. Suddenly you wonder what I'm going to do with that much money. It occurs to you that it's depreciating in bank due to inflation, so you decided to invest it, so it doesn't lose its value. You browse websites looking for the perfect investment. You find many investment gurus on YouTube who advise you that the stock market is the best place to invest your money and make it appreciate. Perfect! You tell yourself, open an account and transfer the whole $300,000 to your new broker. You pick a guaranteed ABC stock to put all $300,000 in. You think to yourself, how easy was that? Now all you have to do is wait for your portfolio to grow in value and you will see yourself on a luxury yacht with your new girlfriend. You watch the investment almost every day and you can't stop wondering. Ever since you invested, your portfolio value has only gone down. Because you've read everywhere that you need to hold on and stop the stock market declines, so when you are at an open 50% loss, you keep telling yourself that stock will pick up and start rising. Unfortunately, that doesn't happen, and when you lose 70% of the amount you put in, you close the trade at a loss and deposit the remaining $900,000 in your bank account. Unfortunately, you just hit a recession and the markets fell for several months, only to have ABC stocks start to rise in value again after your sell-off. You don't even think to look at the chart anymore. There are several lessons to be learned from this story. Number 1. You didn't save any of $300,000 for a rainy day, for example 10% for your own use. Number 2. You invested the entire $300,000 in one stock and didn't take advantage of diversification, as I discussed in the previous video, which would have allowed you to spread the amount across multiple assets. And number 3, and you could say that the fundamental mistake was to invest the whole amount at once, because you never know how a stock will behave in the future. Please, those of you who can see into the future, let me know in the comments. I'm sure it will be very useful at the moment. Welcome to my channel Invest with Jiri. Today's video will focus on the so-called DCA, dollar cost averaging. We will explain its nature and how dollar cost averaging can be used effectively in the stock markets. If you don't subscribe to my channel yet, please click subscribe button and bell so you don't miss any of my new videos. DCA is actually a very simple way to treat the risks of investing over the long term. It consists of setting a fixed amount, for example $1,000, and the assets in which we will invest on a regular basis. For example, stocks and/or ETFs. We pick a stock. The fixed amount, in our case $1,000, is invested in the stock on a regular monthly basis. You could say that we don't care about the price of the stock because if the stock is in a decline, we buy it at a discount in more pieces and at a better price. Well, if the stock is rising significantly, we buy fewer pieces, but the amount of $1,000 doesn't change. The goal of an investor using DCA is to routinely buy at both the top of the stock market and the bottom we are currently witnessing. How long to invest with DCA? This method of investing assumes an investment horizon of 5 years or more, where investing in markets average using DCA will compound over time. It's therefore a strategy that assumes holding stocks with a long-term investment horizon, for example to create a retirement investment portfolio. This is a method that makes the most sense to me personally. If you are one of the traders who trade on a daily basis, DCA is definitely not for you. You need to invest for the long term for DCA to fully develop and manifest itself. What is the real value of DCA? You might think that DCA is the tedious and boring way to invest. But the essence of DCA is a huge benefit, and that is getting away from the daily tracking of charts and worrying about the current price of an investment. This is because once we have too much money invested in one asset, it doesn't give us the time of day and we are forced to constantly monitor the investment even several times a day. This certainly does not add to an investor's peace of mind, and occasionally waking up at night looking at our mobile phone showing the price of a stock portfolio is rather detrimental to us in the long run. An investment portfolio is supposed to give us a sense of peace and security and not to be a scarecrow that wakes us up at night. Perhaps the best way to explain DCA is to give an example. Let's choose our $1,000 to invest on a regular monthly basis in the SPY index ETF, which is an ETF on the S&P 500 index. Since we have the option of buying so-called fractions of ETFs, meaning we don't have to buy the whole ETF but just a fraction of it, we can divide our $1,000 exactly into purchases. For the first month, the SPY price is $380, so we buy 1,000 divided by 380 equals 2.6 ETFs. The second month, the price is $350 and we buy 2.8 ETFs. The third month, the market drops significantly and we buy 3.33 ETFs of SPY at a price of $300. The fourth month is another drop to $220. We rejoice and buy 4.5 shares in the ETF. The fifth month is a significant rise to a price of $410 and we buy 2.4 units of the ETF. What does our balance sheet look like? In total, we have purchased 15.6 units of SPY ETFs at an average price of $332. As you can see, the price ranged from $220 to $410, and therefore the average price of $332 looks interesting. Furthermore, the table shows that the total value of the investment is $6,480, from which we subtract the cost of the purchase of $5,000 and we get a profit of $1,480, which looks interesting at first glance. Of course, this is only an illustrative example of DCA, where the cost of the investment was falling on average and we were able to buy at a better price. If the markets just kept rising, this way of investing could be unprofitable, and that is something to keep in mind. Timing the way we should use the DCA strategy in still evolving markets is very difficult. Therefore, it is better to stop worrying about timing your entry into the markets using DCA and just use its power by averaging and settle for a peaceful sleep. After all, investing is not a race but a marathon. Thank you very much for your attention, and that's all for today's video about DCA. I'm so glad you watched to the end, and if you are interested in investing, check out my Patreon for interesting videos and articles that go more in depth and focus on long-term value investing. Have fun and invest wisely.